Welcome to The Explainer. I'm your host, and today we're stepping right into the shoes of an expert investment analyst. We're going to run a rigorous valuation gauntlet on MFA Financial, a real estate investment trust, using some of Wall Street's most famous and battle-tested investing frameworks. We're talking calculating intrinsic value, breaking down the balance sheet, and figuring out exactly what this stock is really worth. So, let's get into it. Okay, let's dive into the big question right out of the gate. MFA Financial currently boasts a massive 15.3% dividend yield. Now, for any income investor, that number is an absolute siren song, right? But we need to figure out if that yield is a brilliant treasure hiding in plain sight or just a massive yield trap waiting to spring on us. To really anchor our investigation, we're starting with the current stock price, which sits at exactly $9.41 per share. Every calculation, every multiple, and every guru framework we use today is going to be measured directly against this $9.41 baseline.
Here is our roadmap. We'll kick off with a quick company snapshot, run the stock through the philosophies of Buffett, Lynch, and Graham, stress test it with hard quantitative cash flow models, and finally deliver our verdict.
Section 1. MFA Financial Company Snapshot. Let's look at what they actually do and where they stand today.
So, diving into our primary source document, we see that MFA is a hybrid residential mortgage REIT. They have a market cap of around $956 million and an enterprise value of $11.87 billion. But look at this standout metric right here. Their Q1 GAAP book value sits at $12.70 per share, and their economic book value is even higher at $13.22. That is significantly higher than our $9.41 stock price, giving us a really strong initial signal that this asset might be trading at a steep discount to its underlying net worth.
Section 2. The Warren Buffett Lens.
You know the drill. Buffett looks for an economic moat, excellent management, and absolute rock-solid consistency. Unfortunately, as a REIT's operating in a highly competitive space, entirely subject to the whims of macroeconomic interest rates, MFA's moat is virtually non-existent. On top of that, their debt-to-equity ratio of 6.26, which sure is standard operating procedure for a mortgage REIT, is a massive, flashing red deal-breaker for Buffett.
And the source data brilliantly illustrates exactly why MFA fails the Buffett test. Just look at this net income roller coaster. We've got a positive $328 million in 2021, completely crashing to negative $231 million in 2022, and then barely recovering to $80 million in 2023. Buffett demands predictability, and honestly, this is anything but.
We can calculate their approximate owner earnings using their free cash flow, which is currently sitting at a pretty impressive $161.88 million or $1.59 per share. But despite that cash flow, their weak 7.44% return on equity and those totally unpredictable earnings mean Buffett would give this a definitive sell at $9.41. The margin of safety just doesn't matter to him if the business model relies so heavily on debt and cyclical rates.
Section 3. The Peter Lynch Lens.
Applying Lynch's framework, we would categorize MFA as a cyclical asset play, especially given it trades well below its asset book value. Lynch would absolutely love the insider metrics here too. Institutional ownership is at 54.4%, leaving plenty of room for more big players to buy in, and insiders actually own 2.44% of the float, proving management has real skin in the game.
Now, the crown jewel of Lynch's analysis is the PEG ratio. This measures that critical trade-off between the price-to-earnings multiple and projected growth. Basically, anything under 1.0 indicates a stock is undervalued relative to its potential.
So let's do the math. Taking MFA's trailing PE of 10.80 and dividing it by the forecasted 3-year EPS growth of 21.21% from our analyst consensus data, we get a phenomenal PEG ratio of 0.51. In Lynch's world, anything under 1.0 is a screaming value.
For Lynch, combining that rock-bottom PEG ratio, serious insider ownership, and its status as a discounted asset play firmly triggers a buy at the current $9.41 price tag.
Section 4. The Benjamin Graham Lens.
We're entering the realm of deep value now. Starting with Graham's defensive checklist, we get a rapid-fire audit for MFA. It easily passes the adequate size test with an $11.87 billion enterprise value. It passes the moderate PE test at 10.8 and absolutely crushes the price-to-book test at 0.54. It pays an uninterrupted dividend. However, it completely fails on earnings stability due to that 2022 net loss and carries a heavy debt load that Graham would, without a doubt, flag.
But as we know, Graham is all about the math. Let's calculate his famous intrinsic value formula, which is the square root of 22.5 multiplied by the trailing EPS multiplied by the book value per share. We use the trailing 12-month EPS of 0.87 and the highly conservative GAAP book value of $12.70 from their Q1 report.
When we run those numbers, the square root of 22.5 times 0.87 times 12.70, that calculation generates an intrinsic value of $15.76 per share. Against today's price, we are talking about a massive 40% margin of safety.
Graham was a pure numbers guy at heart. Despite the checklist failures regarding debt and earning stability, he would look at that 40% discount to intrinsic value, recognize the hard asset backing, and confidently rate MFA a mathematical buy.
Section 5. DCF and Alternative Models.
It's time to strip away the investing philosophy entirely and let the raw, quantitative data speak. Moving into our discounted cash flow sensitivity analysis, we use a baseline free cash flow of $1.59 per share. Now, the source data listed a weighted average cost of capital of just 0.99%, which, frankly, in this economy is completely absurd for equity risk in the REIT sector. So, stepping in with a much more realistic 10% discount rate and a highly conservative 2% terminal growth, we still find a base case fair value of $19.87. Even in our absolute worst case 12% discount scenario, fair value is $14.45.
As an alternative model, let's use the dividend discount model, which is highly relevant for real estate trust. We identify the annual dividend of $1.44. To be incredibly safe here, we assume 0% long-term dividend growth. Applying our 10% required rate of return, the math dictates a fair value of $14.40 per share. So both the DCF and the DDM point to massive upside.
Section 6. Synthesis and Final Verdict. We've run the gauntlet contrasting qualitative philosophy with hard math. Let's pull it all together. Reviewing our master summary data, the story is incredibly clear. Every single mathematical model, from Graham's intrinsic value formula to our DCF, our dividend discount model, and even a simple reversion to a 1.0 price-to-book ratio of $12.70, prices this stock well above $12. That makes it a quantitative screaming buy across the board, even if Warren Buffett would pass based on the sector's inherent earnings volatility. The key strengths here are that deep discount to book value and the massive yield, while the key risks remain macroeconomic interest rate exposure and leverage.
So I leave you with this final thought. The data objectively proves MFA Financial is deeply, mathematically undervalued, and it's literally paying you a 15.3% yield while you wait for the price to correct. But in the turbulent, interest rate-sensitive world of real estate investment trusts, is the math alone enough to make you pull the trigger? That's the million-dollar question you have to answer for your own portfolio. Keep learning, keep analyzing, and I'll see you in the next explainer.